Welcome to our tax strategy
Welcome to our tax
webinar.
strategy webinar.
I'm Michael Wong with
I'm
Long-Term
Michael
Care
Wong with
Reform
Long-Term Care Reform
Specific,
Specific,
where I help university alumni and professional associate members plan for their future with long-term care strategies. Many of you may know me from our past meetings or webinars on long-term care, but today we're shifting gears to tackle an equally important topic, taxes. I'm thrilled to introduce my friend and esteemed colleague, Mary Reed, who will guide us through strategies to minimize taxes in retirement and within your practices. Mary is a recognized authority in her field, serving as the National Director of Pension and Protection Planning at Pentagra Retirement Services and a partner at M&R Business Development Group. With more than 30 years of experience in qualified retirement plans, Mary has held leadership roles with National and Money Life Insurance, bringing a wealth of experience in plan design, compliance, and marketing. She's also a sought-after speaker and author of 3 highly regarded books on retirement planning and respected educator who has presented at top industry conferences nationwide. We're fortunate to have Mary with us today to share her invaluable insights on tax strategies for retirement and business success. If you have any questions during the webinar, please drop them in the chat box and I'll make sure they're addressed. Now let's give a warm welcome to you, Mary Reed. Okay, Mary, you're on mute.
Muted, you and me. Oh, sorry about that. So welcome everybody. And hopefully we'll be talking about some tax savings information that you'll find useful today. I apologize. I know we were having some technical issues. Hopefully this will go smoothly. We'll hope for the best. So to help with that, I'm going to shut off my video, but I'm going to bring up my screen because it's more important that you see the presentation than you look at me. And it might help with our bandwidth. So please just bear with me a second. I'm going to bring up the presentation. All right, so hopefully everybody can see my screen now. So I'm a specialist in qualified plans. I set up qualified plans for businesses, medical practice, offices like yours, I'm sure. All day long, I do those to help people save on taxes. But I also help people get money out of those qualified plans. You know, everybody loves that the money goes in tax deductible. Everybody loves that it grows tax deferred, and everybody hates having to pay the taxes on the way out. So those are the things we're going to talk about today. So there's a lot of money sitting in these accounts in this country. It's over $34 trillion now. So I'm sure some of the people on this call have money in these accounts. When I talk about qualified accounts, I'm talking about 401k plans, IRAs, defined benefit plans, 403b plans, all those kinds of plans where the money went in pre-tax and has been growing tax deferred. Now, I don't know the ages of the people on this call, but for those who are baby boomers, that money is moving. As people move into retirement or approach required minimum distribution age, these dollars are moving. Now, it may not matter to you what's going on with the rest of this $34 trillion, but I mention this because Congress looks at this money all the time. This is tax revenue waiting to be collected. And so we never know what the future holds. I have no fear that qualified plans are going to be taken away or undone. They've been around for 100 years and they're essential to the finances in this country. But it doesn't mean we may not see some taxes come along the way that change on the treatment of these. One example of that would be the Secure Act 1 and 2 that we had, which pushed back the date age for required minimum distributions, which was perceived as a good thing for many people. But in return, they took away the ability for a beneficiary of these accounts to stretch them out over their lifetime and imposed a 10-year distribution rule. So that just pushes the tax forward. So that's kind of the environment we're in. There's lots of opportunity here to still save money, and there's lots of opportunities to plan to get it out. So just some things when you've accumulated that money just to think about is, do you think tax rates will increase over time? It depends what your view is. And remember, you may be looking out not 5 years, 10 years, but 20 years, 30 years. What do you think that tax environment is going to look like? How much of your retirement account do you think will be lost to taxes? Some will, because it's all subject to ordinary income tax when it comes out. Have you thought about how much of that will be lost? How do you feel about required minimum distributions? A lot of people hate them because it forces you to take money whether you need it or not and pay the tax on that. Do you want to leave more of your retirement account to your family or to the IRS? The IRS writes the rules, and we know who writes the rules wins, unless you do some planning to put yourself in the best position under those rules that you can. And how have you protected your retirement account from market risk in the future, from health risk? The strategy in accumulating that money usually is quite different than the strategy you want to employ when you're using that money. So here's the challenge. If I'm talking to someone and I say, well, how much have you saved in your IRA? And they say, I have $1 million. Great. They've done a great job of saving the money, but they don't really have $1 million because every time they take $1 out of that account, they're going to pay tax on it. So just a snapshot today, for someone who has $1 million, this happens to be someone in North Carolina. That's a middle of the road tax state. If you're in California, you'll have a much higher tax bill than this. But with this conservative number, the IRS currently has a lien on this $1 million, so $422,500. So while the statement says $1 million, this person really only has $577,500. That's really theirs. That is a challenge, and that is usually not how people want to see their money come out. So most people, I find, I've been doing this for a very long time, have kind of the same objectives in retirement. They want to get the most out of the money that they've saved. They want to pay the least amount of taxes. They want to have low risk. They don't want to be in a high risk environment, and they want control. They want control over when they use the money and how they use their money. As long as that money stays in that qualified account, the IRS has first control. Right? They'll tell you if you take it before you're 59 and a half, you'll pay a 10% penalty. If you don't take it and you wait when you hit required minimum distribution age, you will have to take what they tell you. When you pass away, whatever's left in your account goes to a beneficiary. If it goes to your spouse, they can now make it their own. If it goes to anybody other than a spouse, such as children, with some very few exceptions, that money has to be distributed within 10 years. And then that's the end of the account. So the IRS, they're not controlling every dollar, but they have those overriding controls over when and how you can use the money. So what are your choices? So if you've accumulated money in one of these accounts, the most common one that people do is let it sit there. Let it keep growing tax deferred. Take the money either when you want or when you finally have to with required minimum distributions, and prolong that account as long as possible. That is the most common scenario that people do because we all like to defer taxes. We don't want to pay taxes. Option number 2, do a Roth conversion on the money. I have a lot of conversations with people who think about Roth conversions because they feel like tax rates are going to go up, or they're trying to control their tax bracket in retirement and so don't want to have to take taxable income. Either of those scenarios, you're still under the IRS rules, including that 10-year distribution for the beneficiary. And then we're going to show you a third option today. And what this option does is similar to a Roth. We're going to reposition from the money from being in a taxable position to a tax-free position. However, we do it with life insurance. And the reason we do that is because life insurance is a tax-free vehicle, financial vehicle. This is not about, gee, I need to buy some life insurance, although it is life insurance. This is about tax strategy. Life insurance is a tax-free financial vehicle here, and we're working at the intersection of pension tax law and life insurance tax law. So pension tax law allowed you to put the money in deductible and have it grow, tax deferred, but we'll tax it when it comes out. Money in life insurance policies grows tax-free. It is accessible to use tax-free. It will ultimately pay a death benefit tax-free, so there's legacy. And these policies also have access to tax-free money if you have a major health event and need it for that. And the IRS gives us a special rule when we buy life insurance inside a qualified plan. When we distribute that policy, we're taxed on what the IRS defines as the market value of that policy, not the dollars you put in. That is a unique tax treatment that only life insurance gets when it comes out of qualified plans. And that will reduce the tax bill. And I'm going to show you some samples of those numbers. This is an insurance product. So insurance by its definition is a transfer of risk. So it also, besides the tax savings, addresses some risk issues on that money. The policy numbers I'm going to show you today are an indexed universal life policy. In that type of policy, you're credited interest based upon market performance inside the policy, except when the market goes negative, the policy freezes. You never get the losses. You only ever get the upside. This is a 5-year strategy. We will pay taxes in year 5. It's not tax evasion. We're not trying to wear the orange jumpsuits on the side of the road. But once you pay your tax, you're done. Everything after that is tax-free. So if we start to see increasing tax rates, it no longer affects this money. Lastly, longevity. Most people want to live a long time, but they don't want to run out of money. So we'll look at how income can compare in the 3 strategies to see what might provide the longest stream of income with the least amount of risk. And then, of course, there's also if you live a long time but you get sick and that you get those expenses, that is the highest cause of bankruptcy in this country. And so if you don't have long-term care in place, the money comes out of your assets. Here, a life insurance policy of the type that we use here creates another source of funds that if you ever need them, they're there. If you don't use them, great. They'll get paid to your beneficiary. But if you need them, you can access them. All right, so let's just talk about required minimum distributions for a minute. Everybody is going to be subject to required minimum distributions. If you're born before 1960, they will start at age 73. If you're born in 1960 or later, they will begin at age 75. So when required minimum distributions come around, you go to the IRS table. You take the factor for your age, you divide the balance you have by that factor, and that's how much you have to withdraw. So I've just converted it to a percentage here. That at age 73, you have to withdraw 3.77% of your account. But as you get older, your life expectancy shortens. And so the IRS table is designed to empty your account by the time you die. So with each year that you get older, the percentage you have to withdraw from your account climbs. So if we start at 3.77%, but now you're 80, it's up to 4.95%. Make it up to 85, you're at 6.25%, and you can see it keeps climbing. So this puts you in a position of having to make a choice between 2 options. If you stay in a conservative investment, which most people want to do at that point in time, you're not going to get these higher and higher returns to replace what you take out. This is the rate of return in this column you have to earn to replace what you take out. At 3.77%, you have to earn 3.92% on what's left to replace it. That's not too bad. But by the time you're 85, you have to be getting returns of 6.67%. You make it to 90, now you're at 8.92%. So the older you get, the higher return you need to replace what you're taking out. And if you're not getting those higher returns, your principal will decline. Most people don't want to see their principal decline because they're afraid of running out of money. But those are the 2 choices. They also don't want the added risk. As long as you're under these required minimum distributions, this is a dilemma you have to deal with. Now, if you do a Roth conversion, you don't have this anymore. No required minimum distributions. If you do the life insurance alternative strategy, no more required minimum distributions there either. But if you stay in that traditional IRA, 401k, there will come a point when you're going to have to wrestle with this and make some decisions. And of course, we all know there's market risk. These red numbers over here are showing the drops from the peak of the market to the trough of the market when the market took a drop. Some people on here may remember 2008. We had a 52% drop in the market. And if we look at it in graphic form, the market does climb over time and we can all make money in the market, but it does drop along the way. And so when it drops in year 30, you can sit it out and wait it out. But as we get older, that becomes more of a challenge. These green bars are showing how long it took to get back to break even when the market dropped. And these are very long periods of time. You can see 14 years, 23 years, 29 years. So, if I'm 30, okay, I'm fine. I'll sit and wait it out. But let's say you were 70 when the market dropped here. And now maybe you need that money for your retirement, or certainly when you get to the age where you're required to take your minimum distributions, you will have to take it out. So this sequence of returns becomes an increasing risk because If you're not taking the money out, you can recover. But if you're taking the money out, you'll never recover from those losses. And now it's not only the account owner, but now that our beneficiaries have to empty the account in 10 years, they get caught up in this as well. And that 10-year rule is a Roth. It doesn't matter if it's traditional or Roth. They're under that rule. Now here, if we went to the life insurance strategy, remember I said this policy never goes negative with the market. It freezes. So if you were sitting in the policy here and the market took this drop, you'd stay right where you are. The next time there's an uptick in the market, you would go up from there rather than having to dig out of the hole. So, life insurance is not magic, but there are some unique features in life insurance policies that aren't in other financial vehicles. This is one of them. You will get the upside in the market, but never the downside. All right, I keep talking about the Secure Act. Here's just a little more information. And this does apply whether you've converted to a Roth or it is a traditional account. As I said, spouses are exempt. When a spouse inherits the account, they can make it their own. And then all the rules apply to them with their age. But if it goes to anybody other than a spouse, with some very limited exceptions like a disabled child, that account will have to be emptied in 10 years. And frequently we think about passing these accounts on to our children. They're not children anymore. And chances are they may be at their peak earning years in their career. And now they're suddenly going to get this chunk of money, however large it might be, and be forced to pay tax on it, potentially at the highest possible tax rate. Trust me, Congress thought about that. All right, so let's get into this alternative strategy. So we're trying to accomplish some things here. It will reduce the tax bill, as you'll see when I show you the numbers. It is life insurance, so there will be a death benefit at point that will increase the legacy that goes to beneficiaries. It'll get you out from under those required minimum distributions. It reduces market risk, reduces the risk of being subject to higher tax rates later on, and adds those tax-free living benefits if you have a major health event and need to access the money. So here's my 55-year-old again, right? So if they have $1 million sitting, it's probably in a 401k now, it'd eventually get rolled to an IRA. If we look out to the future, if I'm assuming this account keeps growing at a 5.94% annual compounding rate, which is based upon historical rates, that all the growth will be taxable, all the years that's in that account. So, if you pick an age, I just have different ages here. I've highlighted age 90. If they died at age 90, the tax on that account, I add up the tax on their required minimum distributions and the tax that their beneficiary will ultimately pay on the remaining balance, the total taxes on that account become $2,393,000. That is on a current $1 million account. If we go to this life insurance strategy instead, the tax bill on the same $1 million is $379,000. So by repositioning the money for this client, we can save them $2 million in taxes. Compared to a Roth conversion, if I took that $1 million and converted it to a Roth, I'm going to grow it for 5 years first because for year 5 is when I'll pay the tax on the life insurance strategy. So I want to do the same time horizon. That $1 million, again, I assume it's growing at my assumption rate, is now worth $1,333,000. If we converted it, the tax bill is $553,000. If I put the $1 million into this life insurance policy, the market value that is the taxable value under the IRS definition, and this is a safe harbor definition, so they can't challenge this, their definition, is $915,000. So now we only pay tax on $915,000 instead of $1,300,000. And our tax bill is $379,000. So compared to the Roth conversion, we save just under $174,000 in taxes. That's money you get to keep, invest, grow for your future. So some more specifics here to get into the details a little bit more. You can see it's my same 55-year-old. Here's that tax picture we just looked at. And you can see my tax assumption rates here. But let's look at the benefit side of the equation. If we put this $1 million and we bought this life insurance policy and this client never used it, they don't need the money. It's all about legacy. I don't know, they win the lottery. They don't need the money. They die at age 90. Their beneficiary is going to get a tax-free death benefit of $5.8 million. But there's tax-free cash building up in this policy. So maybe they want to use that in retirement. So I just ran this. If they wanted to start taking money out of this policy at age 65 and count on taking it every year until their age 100, the policy, by the way, is still enforced to 120. There's always some death benefit. They could pull out this $92,829 every year as tax-free income in their retirement. No income tax. It won't boost their tax rate. It also means it doesn't affect their Social Security, and it doesn't affect their Medicare premiums. It's completely tax-free income. If they do that, I ran it to age 100, but let's say they die at age 90. I add up that income from age 65 to 90. I add to that the remaining death benefit the policy would pay, and the policy's paying a total of $2.9 million. Now, if we did the Roth conversion, we could pull out the same $92,829 tax-free from there. So when I run out those numbers, it actually comes out pretty well. It pays 4.6. We've done better than the life insurance. The traditional account, however, does the worst. This is what most people do because we don't want to pay that tax. But we end up with the biggest tax bill and the least amount of after-tax money. Now, there are two other factors we have to consider when we compare to the Roth. Number one, we paid a greater tax bill on the Roth. That greater tax bill was $173,688. So if we did the life insurance instead, we get to keep that. So if I assume it grows at the same rate of return and same tax rate, and I look out to age 90, that's worth another $1,097,000 in this client's pocket. I add that to what the policy itself is worth. And now with the death benefit, we're way ahead. But even with the income, we're approaching the Roth. We're a little bit behind. We're just under 4 million, and the Roth is still at 4.6. But what are the odds that in the next, I'm going from 55 to age 90, so in the next 35 years that the market is never going to have a loss? That's what these numbers reflect, that the market never has a loss. We know that that's not reality. So if I run the same analysis, but I assume the market dropped once every 7 years, which historically we typically see a correction once every 7 years on average, this Roth goes from paying 4.6 to 2 million. The life insurance, what happens when we have those losses in the market? It doesn't go down. So this becomes a question of risk. How much risk are you comfortable holding on to that with that money? You might do better in some years. We don't know what the market's going to do, but you're holding on to the risk that it could be worse. And of course, if those risks hit the IRA, we're just even worse off with the pre-tax money if we've left it in that traditional account. So as I said, it also has these added living benefits built in the policy for this person using this $1 million. These would be the benefits that this policy would also provide. So it looks to these triggers. Terminal illness is a diagnosis of 24 months or less to live. Chronic illness would be the typical things that people end up in long-term care facilities, can't do 2 activities of daily living. Critical illness, there's a list. It would include things like heart attack, stroke. This company also covers critical injury. Could be a car accident, not a sickness. And they also cover Alzheimer's. If this insured person had any of those health issues, they could access up to these amounts from the policy tax-free to use. And the way this works, it's not reimbursement. You don't have to submit bills. You just tell the insurance company to verify it with your doctor, and they give you the money. You do whatever you want with it. In the state of California, which is a very expensive state to need care in, a semi-private room in 2024, semi-private room is costing about $163,000 a year. And this is not a top tier facility. You will pay much more in a top tier facility. Average years of care runs 3 to 4 years typically. So if this person were to get sick when they were age 90 and needed that 4 years of care, and we do inflate it. Historically, we've seen a 3% inflation on these prices. So we're calculating that in. So looking to the future, 35 years out, if they got sick at age 90 and they needed that 4 years of care, they could be looking at about $1.9 million of expense. If they don't have any long-term care insurance, which we know is very expensive, this will be taken from their assets. I'm sure we all know people who with horror stories of parents, relatives, whatever, who had this happen to them. A neighbor on my very own street had their house seized to cover those expenses. It's a very a difficult place for the family to be in. All right, so how do we do this? Well, you can't buy life insurance inside an IRA, but you can inside a qualified plan. So we can buy it inside a 401k plan or a profit sharing plan. So if that plan doesn't exist, we work with clients to help set them up. You have to have some kind of earned income to do it, but not a lot, a few $1,000s will work. So we create that 401k plan. We roll whatever money the client wants to use into that plan. No taxation there. We buy this insurance inside the plan, pre-tax. So again, no taxation so far. When we finished moving the amount of money we want to into that policy, which would be something the client would choose. After 5 years, we have finished moving all the money. Now we'll distribute it out of that 401k plan to that client. That's where taxation will occur. And that's where this revenue procedure, where the IRS defines that it's the market value of the policy that's taxed, will come into play. And that's when we pay the tax. Once that tax is paid, this client now has this personal life insurance policy, which has all the rights and features of any personally owned life insurance policy, providing tax-free income, tax-free living benefits, and tax-free death benefits. And it can be moved to a trust if there's a need for that for the client, depending on what their other financial situation is. Anything they could do with a personal policy, they could do with this one. We just were able to leverage the acquisition of it by repositioning the money into a better tax position. So, the painful part always, we do have to pay the tax. It's not a no tax option. There is no tax option. If somebody tells you there's a way to get the money out of your account without paying tax, they are lying. It is not possible. So it is a lower tax, though. You saw that from the numbers, but we do have to pay the tax, and it will come due in year 5. Clients pay it in all different ways. Maybe they save the money over 5 years. Maybe they pull it from other assets. We could take a loan from the policy to pay the tax and make it self-completing if the client doesn't want to touch any other assets. Sometimes there are deductions that can be taken in the same year to offset that tax. So this is customized, for every client. Every client is a different situation, but there are ways to cope with paying that tax. All right, so I just want to show you a couple of examples quickly so you can kind of get a feel how this might actually play out for actual clients. This is actually a husband and wife business. These are real clients of mine who came to me. They wanted deductions for their business, actually, because they had a really big tax bill. It was just the two of them. They didn't have any employees. This is a very wealthy family. After all their expenses, they had $700,000 of taxable income and a $250,000 tax bill. They wanted that tax bill down. So we put in a qualified plan for them. This happens to be a fully insured defined benefit plan because that has a guaranteed contribution every year. Theirs was $405,000. That was deductible, so that brought their taxable income down to $295,000. Gave them back their 199A deduction, which some of you may be familiar with, and brought their tax bill down to $50,000. They were very happy about that. So their plan is to do this for 5 years. We've just entered year 5. Actually, we're just coming into year 5. That will save them $996,200 in taxes over the 5 years. At the end of the 5 years, they'll have accumulated a little over $2 million, $2,068,000 in this plan. Now, they don't actually need the money. So we're going to use this life insurance strategy to get the money out, but we're going to do it with a twist. We don't have to insure the person who owns the account. The rules here allow us to insure anybody they have an insurable interest in, including spouses and children. In this case, we're going to insure their children. We're going to take that $2,068,000 and buy insurance on their 2 sons. The total death benefits between those 2 policies that will buy is a little over $23 million. We'll do this in a 401k. We'll roll that $2,068,000 to a little 401k plan for them, buy the insurance. Year 5, we distribute the policy. The IRS definition of the taxable value of these policies will be $1,426,000. This client will have to pay tax on that, and the tax bill will be $570,000. But we saved them $996,000 in taxes putting the money in. So after they pay the tax, they still have a net gain of tax savings of $425,000. And we now have $23 million of life insurance in place on their children. The parents will own these policies for as long as they live and can access the cash in those policies tax-free. When they pass away, ownership of these policies, which will continue, right? Because they're not the insured, the kids are, will pass to these children. They'll have tax-free money growing those policies for the rest of their lives that they can use. If nobody used the cash, which in this family they don't think they will, someday when these children die, a tax-free death benefit will be paid to their children. We don't know when they'll die. We just looked ahead. If they both die at age 80, these policies will pay $48 million in tax-free death benefits to their beneficiaries. This is the legacy this couple just created for their grandchildren with their $1 million that they can, their contributions over the 4 years, the 5 years. So a tremendous leveraging tool for legacy. Now, not everybody's quite as wealthy. This is another client of mine. He came to me, he was 62. He had $750,000 in his IRA. He wanted to do this because of the tax savings, but he was uninsurable. So we looked to insure his 40-year-old son. So you can see the tax savings here, just like we looked at in the other graphs. And here's the benefits. We see this big death benefit because we're insuring a younger person here. Now, if dad wants to use the income off this policy, he could pull out about $75,000 a year, tax-free all through his retirement. But again, when he dies, this policy will continue and will go to his son, who will then hold it for the rest of his life. And if we look here, I know it's a lot of numbers. If we had left that $750,000 in dad's IRA and dad died at age 90 after taking his required minimum distributions with my growth assumptions, same throughout the other slides, there'd be about $1.29 million that would go to this son, and he could hold it in an inherited IRA. Now, he would have to take minimum distributions every year. They just came out with those regulations. But on the conservative side, I'm saying, let me let it grow. It's grown to $1,836,000 at year 10 when he has to empty that account, pay all the taxes, and he ends up inheriting $1,120,000. If instead we put the $750,000 into this policy, and dad could take that $75,000 a year of income if he wants to, but he doesn't have to. If he doesn't take money out of this policy, there's no required minimum distributions anymore. He can just let it grow. And if he dies at age 90, instead of his son inheriting an IRA with $1.2 million, he'll inherit a policy with $2.9 million of tax-free money. If we look out to that 10-year horizon where he'd have to empty that IRA and he'd end up with $1,120,000 after all the taxes were paid, this policy has $5.7 million of tax-free money in it. We have just leveraged his inheritance 5 times. That is what repositioning this money can do from a legacy standpoint. So, to kind of get out of the weeds of the numbers here, right? This all starts with tax savings. This is not about saving the money. We're going to close out our hour here and talk a little bit about that. But for those who have already accumulated the money and have that tax bill coming their way, this is a way to look at that money where we can better position it to get tax savings and lower that tax bill. Along with that can come some certainty. We can take some market risk out of the picture. Flexibility, use the money how you want, when you want, not be subject to those IRS rules anymore, and add that added protection of those living benefits so that if you do have a major health issue and you need money, you have a place to go. Those things you cannot get from either a traditional IRA or a Roth IRA. Those are advantages we get by repositioning, using the advantages of life insurance as a tax-free vehicle to do that. We have been doing this for 20 years. I've been doing this for 20 years. We have not had any problems with the IRS. This is clean. We're following their rules. We're using their safe harbor calculations. And just most people don't know that this is an option, which is why we're sharing it with you today. It's not talked about a lot because you kind of need a specialized niche of knowledge here to do this. But there's no reason not to do it in terms of regulatory scrutiny or anything like that. It's very clean. All right, so I'm going to switch gears, but first, Michael, are there any questions in the chat box? I'll be happy to answer them before we move on.
Yeah, Mary. So far.
Okay. All right, and hopefully just everybody's, I know I've been talking a lot, and I'm going to go for about another 15 minutes, and then I'll shut up. And I'll be happy to take questions at the end if anybody has any, and certainly if people think about questions tomorrow, you could always, I'm sure, send an email. I will, whenever they get to me, I will be happy to answer them. So that was all about how do we get control of the tax bill on money that we've saved. But let's go to the front end of the equation about getting money into these plans. So as dentists, I'm sure you own practices, and as business owners, you have the option to put in qualified plans. And I just wanted to talk about this a little because a lot of business owners know about 401k plans, but they don't know what their other options are. And there are many other options. So why do you do a qualified plan? It's deduction, right? You get to put money away and get a big deduction for it. So that's usually the driving factor. But also the assets that we put in these plans are protected from creditors. If you have at least one employee in a qualified plan with you, nobody can get at that money except the IRS and a spouse. Nobody else can ever get at it. So if you were to be sued, if you went bankrupt, if any kind of issue you can think of, it doesn't matter what it is, no one can get at that money. There are very few places where you can do that. This is one of them. And sometimes that's a benefit. Now, some people don't have that risk and it doesn't matter. But some people do in all kinds of businesses. So that can be an advantage. So let's just look at here's a little sample company. I have a couple who own this business. They're both making $345,000, which is the maximum amount of compensation I can recognize for qualified plans. They have their child in the business with them, and they have 2 employees. So, a not untypical little company. So it would be very common for a company of this size to do a SEP. They sit down with their accountant at the end of the tax year and they go, oh my God, I got this big tax bill. What kind of a deduction have I gotten everything I can get? And the CPA says, well, we could do a SEP. Well, right now in a SEP, we could have as much as $69,000 put away if your income is high enough. But everybody here gets the same percentage of pay. So you can see they probably don't care what their child Drew is getting, but they probably care about these 2 employees because they have to give the 2 employees $15,000. Now, SEPs are nice and easy. They're free to set up and it's nice and easy to do, but they're not particularly efficient. This isn't a terrible plan. It's going to save them taxes, but they are giving $15,000 to the employees. If they wanted to give less to the employees, we could do this as a profit sharing plan instead. Pat and Chris still get their $69,000, but now instead of giving $15,000 to those employees, we're only giving them $3,750. This plan also complies with all the rules, just like the SEP did, except now we've entered the world of true qualified plans under a different section of the Internal Revenue Code, and they give us more flexible options. And so we can design the plan to favor some people over others, which we cannot do in the SEP. Now, this takes a little more work to get done. You need a third-party administrator. You need a legal plan document. I'm with a firm that does that. But it's not a big undertaking. It's not a big expense to get that more efficient design if that's something that a business owner wants. I mean, if you want to be generous with the employees, great. Do the SEP. Occasionally, I get business owners who want to do that. But if it's really all about favoring yourself and not giving so much to those employees, also here we have a vesting schedule where the employees have to stay with you to walk away with that contribution. In the SEP, once you give it to them, it's theirs. They could leave tomorrow and that money is theirs. So what does it really cost? We have 2 employees in the plan here, but they're not going to really cost anything. Our total contribution to this plan is $145,500. That's for everybody. In a 34% tax bracket, the tax savings that comes back to the business owner here is $49,470 because this is a deduction. So their out-of-pocket cost to make that contribution is really only $96,030. But of the $145,500, $141,750 is going in for the family members. That remaining $3,750 they had to put in for the 2 employees is being paid by the IRS. It's being paid by the tax savings. And the remainder of that tax savings, $45,720, is going to the business owner's family to help fund their retirement. So the objection that I can't afford this for my employees. I don't want to give my employees money. I've heard all kinds of stories from business owners of why they don't want to give the employees money. It's not true here, because to not give the employees that $30,750 will cost this employer $49,470. They got to pay it in taxes if they don't have the deduction. Instead, they can get the deduction, give the $3,750 to the employees, and get the additional $45,000 for themselves. Now, what if you have more dollars? What if you want an even bigger deduction? Here's that profit sharing plan, but they could also do a defined benefit plan. Now, in a defined benefit plan, we're funding for a benefit that will be defined to be paid at retirement age, and the contributions are whatever is actuarially required to get there. We do not have this $69,000 limit. Now we can make a contribution for Pat of $385,000 and Chris of $398,000. There are different ages, and ages plays in the numbers. That's why theirs are a little different. Now, our employees did go up. We couldn't just leave them out, but there's still a very small portion compared to the owners. And again, we have that 6-year graded vesting schedule here that they have to stay to walk away with that money. So what would that accomplish? If we did the profit sharing plan, we got a $49,470 savings. But if this is a really profitable business with a lot of cash flow to work with, we could do this defined benefit plan with an $895,000 contribution, of which $810,000 is going to the family. Get an additional tax savings of $304,317 for a total tax savings of $353,787. All for this little 5-person company that happens to be cash rich. Now, we could go even further, just to show you comparison. This is a fully insured, what's known as a 412E3 fully insured plan. The difference here, this is not designed by insurance companies. This is an IRS defined plan. They created these during the Depression because they wanted to take the risk out of retirement savings. So in these plans, the money can only go into guaranteed products. That's all you're allowed to have. This is the only type of plan that requires that. Any of the other ones, you can invest in anything you want. But here, it's all guaranteed. If they just did annuity only, that's what the IRS requires, a particular kind of annuity, the contribution would be $742,000. But you're allowed to have life insurance in these plans. And if you want to have life insurance, this is a way to pay for it with pre-tax dollars, and it will raise the contribution. Sometimes that's exactly what business owners are looking for. They want the maximum deduction. That brings it to $895,000. You can see the amount of insurance this is buying on the owners, $4.8 million, $6.2 million, $1.7 million on the child, for a total of $14 million because everybody has to get the insurance. However, actually, the premiums to buy this insurance are in the hundreds of thousands of dollars. So if these family members were to go buy this insurance for themselves, first of all, they'd have to buy it with after-tax money. It would cost them a couple of $100,000. Here, it's an additional plan contribution. That's about $150,000, all of which is deductible. So after the deduction, it's going to cost them somewhere in the neighborhood of maybe $100,000. I know that these premiums are almost $400,000 for all 5 people when I ran the numbers. So you get tremendous leveraging. Now, if you don't need life insurance, you don't want life insurance, don't do life insurance. But if you have a need, everything from something very simple to protect your family to greater needs for estate planning, those kind of things, this can be a very cost-effective way to buy it. And lastly, I'm going to talk just a couple of minutes. Cash balance plans are a type of defined benefit plan. There are the hot plans out in the market these days. Businesses are adopting these all over the place. I do a lot of these plans for businesses. And the reason is it's all about control. These are defined benefit plans, so we can have those very, very large contributions, just like I showed you on those last 2 plans. However, they're defined differently. In these plans, everybody's benefit is defined as an annual contribution credit. It's an annual amount that you get credited to you every year. There are no actual accounts. It's all kind of behind the curtain. It's all one pooled account, but on paper it's defined. So if you were getting a contribution credit of $100,000 and you left in 10 years, you would know you'd get that $100,000 10 times, $1,000,000, plus there would be interest credited every year. But the key here is that we can put every employee in a different group for what that benefit amount is. Now, we can't just randomly do it. We always have to pass discrimination testing, but we get a great deal of leverage. So here's another one. Again, this is a real client of mine. We had an owner and their spouse was on the payroll. Our owner had $200,000 in earnings, not all the way at the top. The spouse was on for $45,000. And then we had these two employees. We combine this with a 401k plan, which is the most common way to design these. We can get greater leverage when we pair them together. So you can see we have salary deferrals here. Now the spouse can also defer and the employees can defer, but I didn't know what they might defer, so I just showed the owner. This is a safe harbor 401k, so everybody's getting 3% of pay. And they're also going to get a profit sharing contribution because that's where I passed my testing. But look at the cash balance amounts. I'm able to give 102% of pay to my owner for $204,000 and 370% of pay to his spouse for $166,000. Look what my employees get, 2.5% of pay. Now, they're picking up some over here in the profit sharing, but at the end of the day, when I add it all together, I'm able to give my owner a $240,748 contribution, 120% of pay. Their spouse, another $168,948, which is 375.4% of pay. Each of my employees is getting 9.5% of pay. My two owners are getting 97.6% of the total contribution here. Now, this is a nice, rich plan, but this can still work even if they're not as rich. We have some flexibility in contributions here. They are committing. They'll have to do this for a number of years, at least 5 years. But they can also flex the contribution a little bit. There's a minimum and a maximum they have to contribute each year. And also, if their income changes, that will affect the number as well. So I'm not trying to teach you how these plans work necessarily today. I just want to convey there are lots of options out there. And I just want to make people aware of them because granted, every solution is not for everybody. But to know what your options are so that you can make an educated decision about what can help you, especially as your practice and your businesses become successful and you have cash flow and you watch those tax bills grow. It's nice to find a way to get that tax bill down. And if you're working with your CPA, CPAs are big fans of qualified plans. It's a conservative thing. They've been around forever. But to be honest, if you're sitting with your CPA and you're doing your taxes and you ask them, have you got me every deduction you can get? And they haven't looked at a qualified plan for you, then the answer is no, they have not. And you really need to look at the option to see if it's a benefit for you or not. So who can it benefit? It's anybody who's profitable can benefit here. Varying degrees of profitability would vary the amounts and the design of the plan, but anybody who's profitable and looking for deduction. You have to have the cash flow to be able to make the contribution to make this work. It doesn't help if we can show some great numbers, but you don't have the cash flow to do it. Maybe driven by tax savings, maybe driven by you're thinking about you want to retire sometime in the future and you haven't really figured out a way to put away money to make sure that money is there when you need it. This can also be a way to pass wealth on to the next generation. And again, as I said, you get that protection from creditors. It doesn't matter what your legal form of business is. All businesses are treated equally for these purposes and can have the same plan options. So that's on accumulating the money. We talked about in the first half the benefits of ways to get the money out. It's all about tax planning and it's all about tax strategy to try and be as efficient as we can and accumulate money and use that money in the most tax efficient manner. And we're always going to have to pay some taxes, but hopefully not pay any more than we absolutely have to. So with that, I'm going to stop talking. I've talked enough. I thank you everybody for your attention. I'll turn it back to Michael.
Yeah, Mary, we have a couple questions. One If there is a 5-year time horizon for funding, what happens if you pass away before the 5 years? Oh, Mary, unmute yourself. Mary, can you unmute yourself?
Okay, sorry, I did not mute myself, so I don't know how that happened. And I had to get off the screen. So you can hear me now, right?
Yes. Did you
Okay. I heard the question. Yeah. So I'm assuming with the reference to the 5-year strategies on that first on the distribution strategy, because I talked about the 5 years. If the insured is the account owner, as soon as you pay that first premium, the death benefit is there and will be paid. So, if you died in year 1, 2, 3, whatever the death benefit that was purchased with that policy day one is there and would be paid to the beneficiary. If we've insured someone other than the account owner, like their child, as I showed in the later examples, typically what would happen if the account owner dies, that policy gets distributed out to the child. They now take ownership of it. They will have to pay tax on the market value when they take it, and they'll typically inherit the balance of the money that was allocated to pay the remaining premiums. So let's say we were doing $100,000 a year, and we had paid $300,000 year 3. The account owner dies. The child would inherit that policy and inherit the remaining $200,000 that had been earmarked to finish up those last 2 premiums. That would be typically how we would set it up.
Okay, we have another question. How do you buy your from a 401k profit sharing plan?
Okay, so the rules for buying life insurance in your 401k and profit sharing plan have been around since the 1930s. So these are long established rules. However, your plan document has to allow for it, and you have to have a third-party administrator who can administer it. So if you are, so the first question would be, if you already have a 401k plan in place, ask your current administrator if your plan allows for the life insurance and if they can administer it. If the answer is no, you could move the administration of that plan to a firm that does. Our firm does. Obviously, we're one of them. We're not the only one, but we're one of the leaders in it. If you're creating the plan from scratch, you just make sure it has that language in there.
Okay, thank you. We have another question. What is the specific difference between death benefit and cash balance? Which one is better?
Oh, defined benefit and cash balance? Great question.
Defined
benefit. A defined benefit plan defines your benefit as a benefit at retirement. So, for example, a typical formula that you might see is at age 65, you'll receive a benefit of 50% of pay for life, something like that. If you were to leave employment somewhere along the line before you get to retirement age, you don't know how much money that plan is going to give you, assuming you're vested. The actuary then turns that into a present value of that accrued benefit. And that's what you'd walk away with. Also, when you got to retirement, the normal form of benefit that there's funding to would be a life annuity. If you wanted as something else, you have to elect that. And it would, if you're going to take a lump sum, it would convert. So it's defining the benefit that will be paid to you at that retirement age. A cash balance plan is under all the same rules, but the way it defines your benefit is an annual contribution credit. So in my example before, if that annual contribution credit was $100,000, and I'm here for the next 5 years, I'm going to be credited $100,000 every year for 5 years. I will also get an interest credit that will be defined by the plan document. It could be a fixed rate of interest or a market-based interest. Typically, it'll be 5%. So now if at any point in time, let's say it's 3 years from now, I want to know what my benefit is on the plan. I know it's $300,000 plus my interest credits. Nobody has to do that present value. Your benefit is defined in present value. So technically, it's the difference. The reality of it is the testing gets a little different. And when we're testing in that traditional defined benefit plan, we're testing on those projected benefits. In the cash balance plan, it gets a little more complicated, and we're able to put all the employees in multiple groups much more easily than we can in a traditional defined benefit plan, and we can give them different contribution credit rates. That's what enables us to really swing the money in present value differently between different participants.
Okay, any more questions? Oh, another question. Can you switch from defined benefit to cash?
From a traditional defined benefit to a cash balance plan, yes, you can.
Okay, any more questions? It doesn't look like we have any more. So, thank you, Mary. If anyone wants to talk to Mary, what they can do is give me a call or send me an email. Then we will arrange for a free consultation with Mary. Oh, and one question. Do you pay tax doing?
If you do the conversion from traditional to cash balance, there would be no taxation. It would just be a redefinition of the plan. The plan is continuing, so we haven't made a distribution.
Okay, any other questions? Okay, I think that's it. Well, thank you, Mary. That was and hopefully really helpful to our participants on this call.
I hope so.
Okay, well, thank you, everyone. Thank you for being here. We really appreciate your time during this Saturday morning.